Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, it's just about 2 weeks. As a matter of fact, it's exactly 2 weeks until the October 5th delivery of the fiscal 2021 budget for Trinidad and Tobago by the Honorable Minister of Finance. And today we're starting our review of what investors and the general public could in fact expect over the 2 week period and for fiscal 2021. And today we're specifically focusing on the revenue side of the budget equation. So let's get straight into it. It's not going to make for very exciting reading, but hopefully it will provide some significant insight for investors and the general citizenry alike as to what our expectations could be. Now let's take a look at revenues for over historically for the past 5 or so fiscal years. And we're taking a look firstly from an energy versus non-energy revenue perspective. Now, it's always been said that the Trinidad and Tobago economy is very reliant on energy revenues, and that has been manifested in significant part in this particular chart. And as you can see, energy revenues in that bright green section has been fairly volatile and would have experienced the fortunes of price and production fluctuations over the past 4 or 5 fiscal years. And we can see in fiscal 2019, it would have been energy revenues would have comprised just around 15 billion of total revenues of around $46 billion. And that's again for the fiscal 2019 period. What's not often spoken about would be the non-energy revenue segment. And that has actually been a lot more stable in terms of revenue generation for the government over the past few fiscal years. And we can see it has averaged just around $30 billion odd from fiscal 2015 to fiscal 2019. And a lot of corporate taxes, personal income taxes, etc., would comprise that non-energy revenue aspect there. Capital revenues are very insignificant or relatively insignificant proportion of overall revenues. And we can see over the past few fiscal years, it has reduced significantly from 5 billion in fiscal 2015 all the way down to just around 1 billion in fiscal 2019. And for the first 9 months of fiscal 2020, which concludes in just around 10 days, we can see that energy revenues have been substantially lower, just around 18.7 billion, and non-energy revenues, or that should be non-energy revenues, however, have been around 18.7 billion, and energy revenues around 5.9 billion. Again, that's only for the first 9 months of fiscal 20. So that would have been data up to June 2020 from October 2019. When we take a further granular look from the tax and non-tax revenue perspective, well, those various shades of blue would represent different sources of taxes. Taxes on income and profits have historically been the most significant contributor to overall revenues, followed by taxes on goods and services. So that would be your taxes such as VAT, etc., and taxes on international trade as well. But again, by and large, taxes on income and profits have been the most significant contributor to overall tax revenue for the state. And we can see that that has also been fluctuating, but there has been a general downward trend. And we can see that overall for non-tax revenue, it has also been fluctuating, and that would comprise energy sector and non-energy sector tax revenues. In the first 11 months of fiscal 2019, and we apologize, we don't have data for the last month, which is September 2019 data. At this granular level, we can see that non-energy and energy sector non-tax revenue would have comprised a fairly equivalent amount of 5.3 billion each. Now, for the first 9 months of 2020, that trend in terms of composition remains fairly the same. However, it should be noted that based on the available data, that both tax revenue and non-tax revenue have been down by just around 20% in each case, which suggests, and again, if that trend continues into the final fiscal quarter of 2020, that revenues would be somewhere for fiscal 2020 in the region of 35 to 37 odd billion dollars in terms of collections. Now, what does that mean going forward for fiscal 2021? Well, not too much in terms of what has actually happened, but we can take a look at some of the revenue drivers for fiscal 21. And we can see that some of the major drivers, including an energy market rebound, and that might be too strong of a word, it should be some energy market stabilization, and that revenue impact should be mildly positive. fiscal 2020 has been quite a challenging and tumultuous year in the energy sector. And fiscal 21 should see, based on the Energy Information Administration's assessments and outlook, should see improved oil and gas prices in the vicinity of around $49 a barrel, and that's the US EIA's forecast, as well as natural gas prices, and it's a Henry Hub of around $3.20 per MMBTU on average for fiscal 2021. Whether or not that translates into improved energy revenues in Trinidad and Tobago with a fairly challenged environment from a production perspective remains to be seen. And of course, it will mean a heightened level of uncertainty for investors. Consumer activity is expected to be a little bit on the lower side, and that is because there has been reduced unemployment, and there may continue to be reduced unemployment for the near term. Both of these factors will or should have quite a significant impact on revenues overall and filter into the effects of lower corporate profits, which would mean lower revenues for the state as well. And all of these things will, of course, affect international trade, which we expect to be somewhat lower. And of course, that should also have a lower revenue impact on overall revenues. So we can see there that revenues are going to be somewhat constrained in fiscal 2021, all other factors being held constant. Certainly not going to get to that 47 or 48 odd billion that was projected for fiscal 2020. Maybe it could be somewhere around the $40 billion region, but we'll have to wait in just around 2 weeks' time to hear what the Honorable Minister of Finance will proclaim on this particular issue. Some of the initiatives that were mentioned or have been mentioned in terms of generating more sustained revenue for the state have included the TNT Revenue Authority, as well as property tax implementation. Now, it's been a very hotly discussed topic, and one of the major comments is that increased taxes will just remove consumer purchasing power from the hands of individuals and citizens and shift it over to the state for them to pursue their own expenditure needs, which may be better directed or more efficient in some cases. That's one argument. However, it does mean that there's going to be less consumer purchasing power if these taxes and revenue collections are implemented. So there could be some offsetting impact in that regard. Now, asset sales and drawdowns from the Heritage and Stabilization Fund, they will represent very important components of, well, not necessarily revenue generation, but drawing down on savings from national savings, as well as the sale of some hopefully productive assets. And all of those factors will bolster revenue in the short term. However, they are not necessarily sustainable initiatives in the medium to long term. And of course, we have been discussing as a country diversification for quite some time. However, this is not necessarily a near-term measure to generate revenue. This is more of a medium to longer-term strategic effort to improve revenues and diversify away from our reliance on the energy sector, which does have fairly significant trickle-down effects on the non-energy sector. Well, that's it for this week's edition. Next week, we're going to take a look at the expenditure side. Does the state have room to cut? And if so, where? We'll take a look much more in depth next week. That's it for this week's edition. For more information, you can give us a call at 226-8773. Check us out on our website at boursinvestment.com. Email us at invest@boursefinancial.com. And you can catch our latest article in the business section of today's Guardian. Have yourselves a great investing week. This has been the Bourse Report.